Whenever we deal with digital businesses, whether it's an e-commerce, a SaaS platform, a game, or an AI chatbot like ChatGPT or Claude, here is the question that many teams try to answer. What actually drives its value? Is it because it's performing better versus last year, or because it has a very high number of daily active users? I'm talking here about the hard numbers, and I'm trying to understand which are the specific KPIs that, depending on the digital business that you're in, are actually moving the needle for stakeholders such as CEOs or investors, the market, but also, of course, for you. But here's the problem. Most digital teams pick a handful of KPIs such as revenue, AOV, engagement rate, conversion rate, and apply them everywhere, regardless of what kind of business they're actually running. And here is where everything breaks down. Take the AI industry, for example, Claude, ChatGPT, Perplexity. Those companies are the fastest growing digital businesses ever, and they're generating hundreds of millions of active users, billions of investments, but at the same time, their losses are huge. They're burning billions of dollars in cash day after day, but their valuations are skyrocketing. They're winning at something completely different than fundamental analysis and P&L, and the people who understood it are tracking completely different things. Hi, my name is Paolo, and in today's video, I'm going to walk you through a framework around the three analytical layers, commercial, marketing, and product, that will help you navigate the complexity of a digital business. And I will show you how those three layers stack differently based on what your digital business actually is. Is it an e-commerce, a marketplace, a SaaS platform, a gaming app, a browser, a social media, or an AI chatbot? And we're going to map this ecosystem using two triangles. At the one hand, we have e-commerce. At the opposite one, AI chatbots. In between, we have a continuum that covers pretty much all digital business that you will ever encounter. By the end of this video, you will know exactly where each business model sits within the continuum and which KPIs are the most relevant to track its value and determine its success. Every digital business can be read through three lenses: commercial, marketing, and product. Most teams are already tracking all of them. What they don't realize is that they're tracking completely different things, and they often confuse the scope of each of these layers. Commercial analytics answer the question, is the business financially healthy? It covers what in finance you would call fundamentals, such as revenue, profit, margin, and it also includes what they call the commercial splits, such as the split by country, split by channel like B2B and B2C, or merchandising category. The best representation of a business health in this sense is the P&L, the profit and loss statement, which is the final scorecard for commercial and financial value. Let's move on to marketing analytics, which tries to answer the question where our customers are actually coming from and who are they. In this bucket, we have KPIs that track things like channel mix or paid performance, CRM, acquisition quality, personalization, and in general, it's the engine that feeds the top of the funnel. At last, we have product analytics, which tries to answer questions like what are users doing inside the digital products and how engaged are they? It includes KPIs such as session patterns, funnel analysis, engagement rate, but also analysis on the friction points. And in general, product analytics is the lens to the behavioral value of your users. This framework becomes really powerful when you stop treating these three layers as interchangeable. All three layers are really important, all three matter, but each one of them answers different questions about the value of your business. And confusing this is when most performance tracking goes wrong. So let's start with the left side of the continuum, the first part of our framework, which is best represented by e-commerce. Here the three layers stack into a clear hierarchy. We have commercial at the base, marketing in the center, and product analytics at the top of the triangle. And the reason is simple. In e-commerce, your digital product is a means to a transaction. Value is created only at the very last point, the checkout, the point of purchase. And the experience that your users have inside your digital platform is actually the channel, not the final destination. E-commerce business is clearly a business of selling, and that's why commercial KPIs have the highest relevance. And of course, KPIs like revenue or profit carry the highest weight in determining the value of an e-commerce. And what about the other two layers, the marketing and product analytics? Well, they are extremely relevant in explaining the dynamic of the commercial numbers. They will help you explain things like why during a particular week the revenues spiked, or why a category is declining, or what's driving acquisition costs up, or how much we lost in revenues because checkout broke. Let's move on to marketing, which in e-commerce to me sits in the middle of the triangle and represents how and why users landed on your digital product. Given the scale of the advertising budget and in general of the marketing spend that e-commerce business have, well, this layer deserves a lot of attention because it's often where most money moves. At last, we have product analytics, which for e-commerce sits at the top of the triangle because it contributes the least to business value. And be careful, I'm talking about product analytics. I'm not talking about the product per se. It's not that the digital experience doesn't matter and we shouldn't take care of it. But consider that competition in e-commerce is getting higher and higher, and execution is becoming more and more a commodity. A seamless checkout today is not a differentiator. It's a table stake. It's a must-have. And from a product analytics perspective, presenting numbers to stakeholders like CEO or investors regarding the positive analytics of your e-commerce funnel and your e-commerce checkout is just not going to stick. And it's not considered as relevant. Not because it's irrelevant to have an optimized e-commerce conversion, but because it's just not as relevant as other KPIs like commercial ones. So a smarter way to tell a story with numbers in e-commerce would be to first look at commercial analytics and then describe and explain the patterns using marketing data and product diagnostics. Product analytics in this context is mainly a diagnostic tools, and KPIs like funnel analytics, interaction tracking, bug diagnostic are critically important, but are not the primary driver of business value. If you want to learn more about the role of product analytics in maximizing e-commerce conversion, well, make sure to check out this video. You will see how product analytics is just one of the many toolkits that a product manager or a marketer has to maximize e-commerce conversion. So here's the strategic implication for you. If you are running an e-commerce, first tell your value story using commercial numbers, and then move on to marketing analytics and then product diagnostics. But what about all the other businesses that are not e-commerce within the digital ecosystems? Let's now talk about some of the most innovative and high-growth companies that are on the market today, AI chatbots. Let's start with a reality check before we dig into the framework. ChatGPT, Anthropic, Gemini, Perplexity, all these companies have one thing in common. They're burning cash at a scale that would make any traditional CFO lose its sleep. Let's look, for example, at OpenAI's 2025 P&L. Well, 13.1 billion in revenue, which sounds astonishing until you place it next to a 34 billion in total costs and expenses, driven above all by 19.2 billion in research and development alone. The result is an operating loss of nearly 21 billion. In other words, for every dollar that OpenAI earns, it spends roughly 2.5 and mostly for building the technology around AI. And Anthropic tells exactly the same story. 9 billion in revenue against 13 billion in costs for a 4 billion operating loss. What this tells us is that these are not companies operating for profit. These are companies that are sprinting all out to own the technology frontier, and they are funding that sprint almost entirely with investor capital. And yet, the market is giving extraordinary credit for it. As we can see, OpenAI closed 2025 at a valuation of $500 billion and Anthropic at $350 billion. And those valuations are not anchored in today's earnings because there aren't any. They are a collective bet on future market dominance and the promise of future cash flow that doesn't exist yet at scale. And the depth of that opportunity is currently being measured. Which brings us to the next core question. If you can't use fundamentals like revenue or profit to assess the value of a business, well, what do you use then? And this is exactly why for digital businesses like AI chatbot, the pyramid inverts. These are not e-commerce, so there is no transaction, no checkout, and in general, very little sales to close. Yes, of course, there are many B2C customers who subscribe monthly to use the AI chatbots. And there are many also B2B big customers that are signing off huge contracts with AI companies. But the reality is the product, in this case AI, is the value. And the only way that it can reveal itself is by how much people are using it, how often they come back, how many queries do they run, how engaged when they're using it. And to AI companies and their investors, it all comes down to whether AI users have reached a point where they genuinely cannot imagine a workflow or a life without AI chatbots. So the depth of the dependency of current and future users is what actually pricing the $500 billion valuation for ChatGPT, which again last year burned $21 billion in cash. They're not betting on today's revenues or profit. What they're truly betting on are the switching costs that are quietly accumulating every time a user or a company builds another habit or workflow around their digital products and services based on AI. And AI chatbots are not alone in this logic. For example, social media platforms like Instagram or Facebook or YouTube itself, but also browsers like Google, they live off very similar rules, all based on users' engagement. The more time a user spends scrolling through Instagram Reels or navigating and browsing the web on Google, the more ad inventory they're able to sell to their advertisers. Whether it's a cost per click or a cost per impression model, it doesn't really matter. The rule of thumb is the following: engagement first, monetization second. The commercial layer is not absent, it's just deferred by design. And this is what makes the early stages of a new innovative category of technology such as AI so different from everything else. Monetization is not the priority here. Attention is, and time is. And all of that doesn't live inside a financial statement. It's only possible to track those KPIs through product analytics, which is of course your on-site or in-app data. The KPIs that we should be tracking in this occasion are active users, session frequency, query depth, retention curves, benchmarked against the total addressable market, feature adoption rates, and so on. These are the numbers that matter right now to all the relevant stakeholders, which are CEOs, investors, and the market in general. And of course, they will sit at the base of the triangle within our framework. But beware, commercial KPIs are being strongly monitored too, and they will eventually earn their place inside the framework and the dashboards. And that will happen when monetization evolves and the business model in general reaches maturity. But at this stage is a supporting actor, not a lead, in determining the value of a digital business. So here's the mental framework that I want to leave you with to better navigate the complexity of the KPIs of digital businesses. You have one triangle on the left where commercial KPIs sit at the base and drive the value of your business. And e-commerce is the clearest example. And then you have another triangle inverted on the right, where product and users engagement is actually best to represent and assess the business value of your company. And this is where AI companies like ChatGPT, Anthropic, and Perplexities are living right now. The interesting bit is that between these two extremes, there is a continuum that contains pretty much every digital business. Marketplaces, gaming apps, SaaS platforms, browsers, and social media are sitting somewhere between these two extremes. And where your business sits within that continuum and which layer of the framework, commercial, marketing, or products, deserves more attention when determining and measuring the value of your company depends all on two factors. First, your business model. Second, the maturity of the market you're playing in. If you're watching this video in 2026, the right-hand side of the framework is represented by AI chatbots. But if we zoom out a little bit, this pattern is not new. Back in 2000, for example, during the dot-com bubble, digital businesses were burning cash at extraordinary rates too, posting negative losses while carrying extraordinary valuations. But then the bubble burst. And even though many of those digital businesses didn't survive the crisis, those who actually survived eventually became profitable. Let's look at Amazon, for example. And today it would be crazy to assess Amazon's value using marketing or product analytics. But what does that mean? It means that at the time, e-commerce was an emerging technology, but it was here to stay, just like AI is here to stay. And those players like Amazon, who managed to grab the biggest market share while turning a profit, are those who actually won the game. And AI, whether or not the AI bubble will burst or not, is gonna follow the same arc. These companies are becoming too large, too embedded, and too strategically critical to just remain permanently unprofitable. At some point, and that point will come, at least some of them will have to turn a profit. And when they will do, they will start slowly moving to the left of this framework. Product will still matter enormously, of course, but the commercial analytics, the base of the triangle on the left, will continue to matter more and more and earn a bigger share of the value story that the market assigns to them. And by the time that happens, well, something new will have emerged on the right-hand side of the framework. There will be some early stage, innovative, cash burning, and engagement first business models that analysts will struggle to value using traditional metrics. Exactly the way people are doing now with AI. And that's the real nature and added value of this framework. It's not static, it's dynamic. And it moves together with technology and innovation. Thanks a lot for watching this video. If you like my content, don't forget to hit the like button and follow for more content. Bye!